Hello, everyone.
Hello.
Aloha.
Good evening.
2021. Good evening. We continue to have people join us. Daniel and I here and trying to sit as close as we can without being COVID related. But it's kind of hard to get us both in the frame at the same time on this computer camera that we have here. To have some very interesting information to share with you, and we'll kick off the presentation with our theme for 2021 is Aloha 2021. What we hope to have, hopefully, if COVID does its thing and goes away, we'll have a big blast in January 2022. We're going to have a Hawaii theme client appreciation event with everything Hawaii. So our theme for this year is Aloha 2021. Our referral program continues to drive our firm, and we're very grateful and thankful to all you clients that constantly refer us. So we'll kick off our referral program again. We'll be sending these flyers you see here. We can share this one with you tonight if you want to download it. But we're going to be sending these out to everyone. And anybody that refers us throughout the years will get a ticket to go in quarterly drawings, and then they'll also those folks that are referred, if they become clients, you'll also go in a year-end drawing, which we just completed a couple weeks back. It's worth your while financially to be in that drawing. We try to have nice prizes throughout the year. We're grateful that you refer us, and our business has grown exponentially since we kicked off our referral program. So thank you very much for it. That said, a couple other things of interest tonight as well. We go ahead and stop this one. We'll show you another one. Go down to the event calendar. Okay, we have an event calendar. You can also download tonight. Again, this is subject to change. Most of this presently is scheduled to be via Zoom or Webinar Jam, something online. We're going to try as soon as we can to start doing public things. But there's something going on every month. For example, next month, we're going to do some Zoom training. We're calling it Zoom 101. And then that's on the second Thursday. On the fourth Thursday, we're going to have a presentation on understanding statements. And so you can see some of the things there. We're going to do master gardening. We're going to do cookie decorating, lots of fun things, double token dinners and things of that nature. If we can do it in person, we're going to do it. If not, we'll try to do it virtually. So the event calendar you can download now, as well as the flyer. We have a couple other things to show you. I'm going to put this up by the camera right now for you. Our first quarter drawing will take place in the first week of April for all those who referred their friends to us during the first quarter, and we're going to be drawing for a $100 Amazon gift card. So just be aware of the calendar and the events, and have someone join you or join us online. They don't have to be present with you, but if they desire to participate in any of our online events or in-person events as the year goes along, you'll get tickets for that for drawings on a quarterly basis. So I believe that's all the announcements we have right now. Daniel, if you can get this presentation up and going. All right. Okay, here we go. We're going to turn the video off so you guys can have the whole screen there and take a peek at it. I hope everybody can hear us well. And we will take any comments or questions you might have as you go along. Just do it. We'll answer them there in the end. Just make sure you put them in the chat box, and Daniel will take some time as we move on. But we're going to be looking back. 2020 hindsight's always good. Daniel and I were privileged to be a part of a discussion in December with some economists, and we learned a few things there. And so we're going to do a little bit of looking ahead where nobody knows what's going to happen anyway, but we're going to look at the data and things of that nature. But first, we're going to talk about where we've been. So it'd be interesting to take a look back and look at things, and if we look forward, I think we should have hope moving forward with what could happen this coming year. As you all are aware, we have to give you disclosure. We're not actually selling anything at all. We're providing information today that hopefully will benefit everybody. So if you'd fallen asleep on New Year's Day in 2020 and just miraculously awakened on the January 1st, 2021, and you took a look at this slide here, the S&P 500 is up 16.26%. You'd have probably been pretty doggone excited. However, if you would have missed also all the difficulty and the angst and everything that went along with getting to that number, because it was a roller coaster ride. None of us did that, but some people may think that nothing really ever happened, and that's not the case. It was very, very difficult. So let's start back in hindsight of 2020 and take a look at what got us to where we are now. On New Year's Eve 2020, the bell rang, told on the wildest year in Wall Street history. It was full of human tragedy, recessions, massive job losses, plagues, remarkable rebounds, and record highs. The S&P 500 returned more than 16% in 2020, but it was a heck of a ride to get there. The Dow Jones Industrial Average and tech-heavy NASDAQ gained 10% and 43%, respectively. The S&P and Dow finished the year on all-time record highs despite the global pandemic and an economic crisis not only here but throughout the world, and not even to talk about the contentious, disputed elections and all the divide we had in our country. It's an amazing story. It will probably never ever be replicated in history. And I'm not so sure any of us want to live through that again, either ourselves. Within the S&P technology sector, it led the way by 41%, as you can see by this slide. And consumer discretionary spending, why? We were all sitting at home. Everybody was locked down in the country. That was up 32%. Communication services like we're using today, Webinar Jam and Zoom, that sector was up 21%. The materials was up 18%. Only the energy sector, which was down significantly for the year, negative 38%, by the way. Utilities were down 4%. Financials were down 5%. Real estate was down 6%. So really, the market was being driven by technology, consumer discretionary spending, and communications. So a little different than what we anticipated, obviously, in January 2020. Now, the overseas market kind of mirrored and correlated a lot with the U.S. market in almost all sectors, simply because we were in a worldwide economic crisis with the pandemic. So it kind of mirrored what was going on across the board all over the world. The final quarter of 2020 was pretty interesting. It was primarily realized gains from at least 3 COVID solutions and vaccines that came on board, which was really a scientific marvel. Nothing like this has ever happened in history. It kind of shows you what we can do when we all put our minds together and try to work together for a common cause. Cyclical value stocks actually were beaten down the most, but they recovered the best throughout the year, especially the last quarter of the year. And we believe, and so many other economists are also saying that the value is going to be a hero in 2021, but don't overlook some growth stocks as well. I don't know if you've been paying attention what's been going on the last few days with these robo guys and driving up these prices on these shorted stock positions. That was ended today, I think, for a while, but that was kind of crazy. But anyway, we had some outperformers in the market. Certainly, if we take a look at if we look at the winners, market gains in 2020 were driven by just a handful of superstar stocks. Three of the biggest tech giants, for example, Apple was up 82%, Amazon was up 0.76%, Microsoft was up 42%, and they accounted for more than half of the S&P 500's total return for 2020. Absent the S&P 500's top performers, the top 24 companies, which were dominated, as we saw, by tech and digital services, the S&P 500 would have been a negative for the year. Just think about that. 24 stocks out of 500-something stocks actually drove the market. And how many folks actually were invested in those three? Now, Tesla, of all things, 743% gain, and now it moves into the S&P 500 in 2020, which can, if anything happens with that stock, positive or negative, have some real challenges and movements in the S&P 500 for the upcoming year. So just to put things in context, just several major companies drove the entire recovery last year from the COVID-19 pandemic downturn. The 10-year numbers, however, for the stock market has been pretty good. I'll share the numbers with you. Basically, on a risk-adjusted basis, the stocks outperformed about 14% per annum over the last 10 years, outperformed cash. Cash outperformed about a half a percentage point. That's about it. Hedge funds were up about 5%, and those are supposed to be the guys that make all the money. And they underperformed, obviously, big time. And bonds also underperformed 4.5%. But fixed index annuities, which we use in our portfolios for most of our clients, had an average almost 6% over the last 10 years. So they did, as we've always talked about, and as we presented those products over the years, better than cash and better than bonds. Obviously, they're not going to do better than the market, and they were built to do so. So it's looking back at over the last 10 years, it's been a very good wild ride, so to speak. Let's move ahead and talk about what 2020 in a nutshell was a great year. But getting there was pretty difficult. It was pretty tough. So why was that? Well, resurgence began primarily because the federal government pushed out the largest government stimulus package ever in the history of the United States. They were frantic. Everybody was frantic with the pandemic. The optimism of the economy, what the heck in a handbasket all of a sudden, and it started being stimulated. The Federal Reserve Chairman, Mr. Powell, pledged to keep interest rates as low as long as it was necessary, and he did so. He made the comment, whatever it takes, that's what they were going to do. So it was unprecedented. They did things that's never been done in the history of our country. And it worked. It actually kept things going, but it kept things going at a price. As a matter of fact, in the Congress, they acted aggressively as well. They approved $3.5 trillion in emergency relief and stimulus measures, the largest action ever in the face of recession in U.S. history, and one of the biggest aid packages of any country in the world, if not the largest. However, a lot of that, as we well are aware of, the second round is going to end probably in the next few months, and vaccines aren't readily distributed, that we could have some uncomfortable times moving forward as far as that goes. The Fed's action sent mortgage rates also to all-time lows. Not only did it go very low, but it also triggered a home buying boom that sent prices on homes sky high. As a matter of fact, in the Dublin area where I live, you really can't find anything to buy. It's a seller's market. There's not much on the market at all. And when you can get 30-year mortgages for under 2.7% to 2.5%. That's the reason. So the Fed's action sent that positive thing happen. But what happens with that, the prospects of commercial real estate is taking a toll, as well as many people are starting to work from home, and many companies are liking the idea of having their employees work from home. So there's a shift in that, which has affected the commercial real estate markets. Markets are largely ignored. This whole time frame had large Main Street ignored Main Street America. We've had pronounced unemployment. As a matter of fact, we had a high of 22 million jobs that were lost last year. That has gained back about 50% of those. Almost 12 million people have come back to work now. There's been some slowdown in the last few weeks because of an increase in the surge of infections. But about 4 million U.S. businesses have closed, some of which will probably never come back. But most of that's driven mainly by restaurants and gyms and other small companies. According to the Economic Policy Institute, more than 25 million U.S. workers remain unofficially employed or otherwise out of work due to the pandemic at its highest point. And many have experienced also a reduction in hours. So, as we sit here, things are not where they ought to be in an optimum situation at all. But somehow, however, the future looks pretty bright. They need to wear shades anyway. So darn bright. Goldman Sachs, for example, has just forecast that the growth of the U.S. economy would be 5.9% in 2021, which would be the best increase since 1984. And the unemployment rate is expected to fall to 5%, according to the Federal Reserve, and from its present level, 6.7%, from a high of 14.7%, meaning that another 2 million people will return to work. The corporate earnings are also forecast to balloon in the second half of 2021. Critically, and analysts say stocks remain appealing for many reasons, particularly low interest rates on other types of investments. So, as Daniel and I attended this economic seminar this past December, we heard the same thing, that pent-up demand, the rolling out of the virus, those things will cause the second half of 2021 to probably be fairly robust. However, this rebound really reflects a lot of optimism on Wall Street, but it also underscores the disconnect between the stock market and the struggling American households, because there's still a lot of people hurting. Life on Wall Street and Main Street doesn't need to necessarily correlate, but it often does. And so that's something to be aware of. By the summer, any major economic worries were dissipated last year, and as we all know, jobs came back, people took more risk, and not only that, some people weren't actually spending money. Our savings rate in this country went up to an all-time high. It's been announced that U.S. household savings increased by more than $1 trillion in 2020, driven by the government stimulus and also fewer places to spend money, but at the expense of a lot of industry, as we mentioned a moment ago, travel, restaurants, gyms, etc. There's now worth about north of $1 trillion that have been accumulated in savings during this past 8 months. That's a lot of money. This is only a downturn. Richard Potter, the vice chairman of the Federal Reserve, said in November that this $1 trillion accumulation in savings is the only downturn in his professional career, basically, which he's ever seen such disposable income grow at that rate. Well, we couldn't do anything. So the money's there. The seminar we attended in December, that was part of the discussion, was the pent-up demand. As soon as things are relaxed and there's some more surety about where the pandemic is going, the demand is there for spending. And so Americans know how to spend money. For once, they know how to save, but are they going to continue to save? We don't know. But anyway, the demand is there that would actually really drive the economy moving forward. Many economists look at what happened in 2019 as a K, kind of like a K type of a basis where, typically you hear the word V or U-shape. They look at the K because of the disconnect between those who have and those who have not. You see the industries there, the travel industry, travel, entertainment, hospitality, food services. They have not recovered at all. The other major sectors of the economy has recovered. So that's a sad story. 1 in 8 it's been stated that 1 in 8 Americans more than 1 in 8 Americans, more than 27 million Americans, especially those who have been hit hard in the economy, go without food at least 1 meal a day right now in our country. That's not good. The last part of my conversation is going to have to do with the U.S. Treasury. I think it's in the best interest of the United States government to keep interest rates low because of all the debt. They have to service the debt. And the Federal Reserve Chairman has already stated that he's going to keep them as low as he possibly can for as long as they possibly can to stimulate the economy. And I understand that because that corporations do well in low interest rate environments. So does consumers. So it's good. What happens is the ones that want to save money and protect money and things like CDs and bonds and government bonds and bills, they're the ones that get hurt. But it rallied big time because everybody went to safety. So they were buying U.S. Treasuries at clips unknown in history and drove down the yields from the lowest closing yield was 0.50 in March 8th of this past year. And at the end of the year, at a remarkable 0.93%. So just not quite 1%. That's a 10-year Treasury. That's not a lot of money. So there was money to be made in Treasuries. If you got in early, you made 0.5% or so. As always, market risk are noteworthy, and any deviation from the rosy overall picture that we've been talking about a bit here could lead to any type of correction, or it can be worse in 21 than it was in 20. We don't know that. I think that what we learned from our research and being in the seminar was that COVID is something that is unknown that could cause havoc moving forward. Even though the market is doing well, there are still a lot of people out there hurting. So Main Street's in pain and the market's doing well. And we hope to be able to navigate through this in a way that we protect our clients, not only today, but in the future. So Daniel will now take a few minutes and start talking about what we see ahead of us.
Okay, everybody still with us? We hope so. So I'm going to spend some time here and talk about what we anticipate may happen in 2021, how the economy may perform, and take some questions once we're done with that. So let's start with how people are feeling about the market. Believe it or not, there's a thing called, consumer sentiment, and there's a foundation called American Association of Individual Investors. They show that consumers are more confident about the markets than they have been in a very long time, and bearishness is at multi-year lows. So that's a good sign. The economy is expected to do well, especially in the second half of this year. And the hard part though is we're still dealing with the pandemic, and we've got to get through that before we can really see the consumer spending, and that's what drives our economy. Over 70% of it is consumer spending. So right now, people are very optimistic. Consumers feel like the market should do well. So, some people see warning flags, right? And others see a parade. And that's because, different people have different approaches to investing. But one of the reasons markets have done well is there's two terms I'm going to throw out there to you. One is called TINA, and that stands for there is no alternative. So if you want to get a return on your money, you can't do it at the bank, right? You're not making any money with interest rates at all-time lows. So many people invest in the market because they don't know of any other alternatives. Of course, we believe in diversification, and we use other principal protected investments that aren't in the market for many of our clients. But for many people, they don't see another alternative to the stock market. The other term I'm going to introduce is something called FOMO, fear of missing out. Those are the watchwords that you're going to hear people say up and down Wall Street, and heard it last year. People stayed invested in the market because they didn't want to miss out. A lot of times, people jump out of the market when it's at the bottom. Historically, that's what people do. They sell when they should be buying, and they buy when they should be selling. So having a plan will prevent people from doing that. Let's look at some other things that are likely to drive markets this year. The biggest thing everyone knows about, and we're ready to not hear about ever again, is COVID. And we're still seeing all-time highs, unfortunately, and cumulative deaths, of course, are over 400,000. It's a tragedy. We're also seeing more vaccine doses being administered. So that's a good thing. If we look at this chart on the 18th of January, the cumulative doses administered of vaccine topped 12,279,000. But there's 123,000 people hospitalized. So you can see on the far right-hand side of this chart, cumulative vaccine doses distributed versus administered. 31 million have been distributed, but only 12 million have been administered. So we've got to find a way to more quickly get the vaccine administered. So that's been a real issue all across the country. I was just talking to some clients earlier today that live in Tennessee, and they said that it's a real mess up there, and they aren't getting it distributed nearly as good as they are in Georgia. So hopefully we can have the rest of the country pick up the pace. We sure need to get the vaccines administered. So let's talk about how this recession that we just came through, and it does classify as a recession. The technical definition of a recession is 2 quarters in a row of negative economic growth. So if you look here, what you see is the number of months on the bottom axis, number of months since the last unemployment peak. So the Great Recession, it took over 70 months, almost 80 months to get back to where we had full employment. Other post-war recessions, they took between 30 and 40 weeks. We're about halfway back, and we're about a year in now. So we still have to have more robust employment before we see a full economic recovery. You have to remember, too, that sometimes the unemployment numbers, which we will talk about in a minute, but sometimes they are reported to be lower because if you have given up looking for work and it's been more than 6 months, you actually fall out of the unemployment number. So there are a lot of people that are unemployed or underemployed right now. So that's a major focus moving forward that we have to accomplish. All right, so Bill a few minutes ago mentioned that last year the S&P 500 was over 14% total return for the decade, and last year it was over 16%. So sometimes people think, well, my goodness, why don't I just put all of my money in the S&P 500 and be done with it? Well, the reason is it's not diversified enough. As he mentioned, a handful of stocks, 5 technology stocks, drove returns for the whole S&P 500. They accounted for 50% of the growth, just a handful. So we believe in diversification. If you look at the returns from 2000 to 2002, the S&P was down 40%. But if you had a diversified portfolio, you were only down 17%. Diversification means owning a lot of different asset classes. You don't want to just own large cap stocks with a heavy emphasis in technology, and that's what you get with the S&P 500. We like value stocks dividend paying stocks, and those are much less volatile. And if you look generally, much less volatile compared to growth stocks because they pay out their earnings. So diversification does work, but sometimes it might not feel like it's working. Sometimes it can work even when you feel like you're losing. Like if you look over the whole period of time from 2000 to 2020, the total return of the S&P 500 was 268%. There was many times if you had a diversified portfolio where you owned all kind of different asset classes, large cap stocks, small cap stocks, bonds, and you were diversified, you might have felt like you were losing, but actually your cumulative return would have been higher and you would have had a smoother ride. And your $100,000 that you invested would have become $375,000. So diversification does work, and we believe in being diversified. So I've had a lot of concerned clients talk to me about what's going on with politics. And I think this is a smart statement. If you mix your politics with your investment decisions, you're making a big mistake. And the reason for that is stock markets are driven by corporate profits. They're not driven by the president. Now, certain policies can hurt certain sectors. That's why you saw that we rebalanced portfolios to take into consideration what may happen under our current administration. There's always opportunities if you know where to look and you're diversified, but you don't want to base your investment decisions on political ideas because you'll lose out. Here's some examples of people being dead wrong about different market ideas that they had. So this is from the Wall Street Journal from March 6, 2009. This guy wrote an op-ed and he said, Obama's radicalism is killing the Dow Jones Industrial Average. So the interesting thing about that is that on March 6, 2009, that was the day that the S&P 500 was at its lowest. From that point, it went up 232%. So, that didn't pan out. The markets, they did recover. They went up 232% from that date until when Obama left office. Now, it is true that certain policies can stifle growth. Like if you raise taxes on corporations, they're going to have less profits. If you have minimum wage raised to $50 an hour, it's going to cut in profits, right? So obviously there are policy decisions that impact markets, but we still have to focus on realizing that the stock market is driven by corporate profits more than anything. Here's another example. Paul Krugman. I'm not a huge fan of Paul Krugman, but here's what he said when Donald Trump took office. He said that markets would never recover. That's basically what he said. He said markets would never recover, and he ate those words, obviously. So the markets did very well through President Trump's tenure. So don't listen to the talking heads. They're all they're trying to sell newspapers, right? So sell media. So focus on the fundamentals, and there are a lot of reasons that markets should do well this year. So a concern that we have, and everyone should be concerned about it, is some of the stimulus. There's a lot of stimulus money that's been thrown about, and our debt and deficit levels are really inflated. If we look back to 2009, the national debt was around 12 trillion, and now we're at 28 trillion. That's crazy. Just in 11 years, almost 12 years, $28 trillion from 12 trillion. So we have to think going forward, this can't go on forever. So we are somewhat concerned, and we always keep an eye on the debt level. Now, what economists look at is the debt to GDP ratio, how much debt there is versus the amount of gross domestic product. And luckily, our GDP is high, and so we are over 100% debt to GDP ratio, which is concerning. But at some point we've got to find a way to get off the debt train. So let's talk for a minute about the fact that a lot of Americans, especially if they're service workers, they have really been affected. Their hours or jobs have been cut or eliminated because of the pandemic. And unfortunately, there's still tens of millions of people that are jobless, hungry, on the edge of eviction, and they need help. I did see that charity giving was at an all-time high last year, which is a good thing. So we still have a long way to go. We have a long way to go. And as Bill mentioned, there's a difference between Wall Street and Main Street. So Wall Street and those of us that are invested in the markets have been rewarded, but people that are in the lower half of the economic spectrum, they have not recovered, and they still are struggling. So let me say this. Even though we're going through a hard time right now, don't bet against America. You shouldn't underestimate our ingenuity, the resilience of the economy. There's a lot of reasons to believe that markets are going to continue to do well. And avoiding stocks is a betting against the American economy and American ingenuity. So I think it makes sense to invest and diversify and have a financial plan and to be optimistic. I will say I think the first half of this year we're going to experience some volatility. You can already see it in the last week. We've seen market swings. It'll be up 2%, down 2%. So we're going to see this volatility until we have a little bit more clarity as to when people can get back out. But the reason that we have over 5% GDP forecasted is because people have not been able to go out and spend money, and there's pent-up demand. People want to go out. They want to travel. They want to go see their families. They want to make purchases. So we should see a very strong second half of the year, and we think that value stocks should be rewarded because tech stocks, they are at very high prices. They're close to what they were in the late 90s, and that cannot go on forever. So we think there's going to continue to be a rotation into value stocks. And we made some portfolio changes in many of your IRAs, and we're in the process of looking at non-qualified accounts as well. But we made investments into some other sectors. We think that infrastructure and clean energy should do well. Transportation should do well. Infrastructure spending is likely to be up. So you'll notice in your portfolios we've got exposure to certain sectors which should get investment under our current administration. So stay positive and don't bet against America. That's my message. The other thing is don't try to time the market. Last year, the market, it was down quite significantly, but then it dropped 30% or so, and then it jumped back in the end of the year 16% up. So there's a lot of years where there's a large downturn, and then the market recovers and has a positive return. Going back to the year 2000, you can see there's several years, almost every year, where the market went down, but then it ended up recovering. So in 2000, the market dropped close to 20%. 2003, the market was down about 14%, and it ended up over 20% for the year. So there's a lot of examples of years where markets are down, and you can see the light blue is the largest intra-year decline, and the blue is the total calendar year returns on the top. So a lot of years we'll see downturns and then the market recovers. But we do expect volatility, in the next few months. But that doesn't mean there's not opportunities to still make a return. It's just not going to be as smooth of a ride as we've seen since October. So this is our desire, right? It's the top one. We want to go from point A to point B in a straight line. But reality is much different than that. Life is like that, right? We have all kind of twists and turns. So we all want the top one. In reality, we get the bottom one. So in conclusion, I think that there's reasons to be optimistic as soon as we get this pandemic under control, and stores are able to open back up. Unemployment will slowly go down, and we should see a recovery in the jobs market. So we're optimistic for this year. And although there's a lot of fears about politics, focus on corporate profits. That's what drives markets, is corporate profits. So we do believe that those should be strong during this year. So now I'm going to open it up for any questions that you have. Does anybody have any questions? Just type them in the chat box over on the right-hand side. Anybody have any questions? No?
Well,
Give you a few more seconds if you want to type up a question. Okay. Well, we hope to get to see some of you in person this year, hopefully. And until then, we'll be having these online events, as Bill mentioned, and we shared the links there you can download the calendar and also our flyer for the upcoming. Well, now I'm getting some questions. Let's see. Thoughts on cryptocurrencies. So cryptocurrency is a type of currency. Bitcoin is the most common one. They've gained a lot of popularity. There were several years where people didn't know if they were going to be considered legal, but then the government regulated the market, which legitimized it. So I think there's a future for cryptocurrency. I do think it's much too volatile for most retirees to invest in. There's not a really good way to do it. You can't just buy Bitcoin in a stock portfolio. You have to buy things related to it. You really have to buy it directly. But it got up over $40,000 for a Bitcoin, and then it dropped down to 30. It swings all over the place. But many people think it may become the first global currency, meaning accepted globally. PayPal now accepts Bitcoin. So there probably is a future with it. I think it's still too early and too risky to invest our client's money into it. I hope that gives you some information. Let's see, is there any more questions? Wait, here we go. Thanks, guys. Can you make all the charts and graphs available for download? We can share some of those with you, Gary. I'll have them sent to you. We can't share the presentation in full. We can give you some charts and graphs. Any other questions before we sign off?
that was this one here. What was your moment?
Yeah, that's a question.
Okay.
All right.
Hey, thanks, everyone. It's hard to get us both in the screen at the same time. My ball head's coming this way.
Oh, we have another.
Another question? Okay.
I just listened to the podcast, Talk Bitcoin to me. I'll have to listen to that. So there's a lot of divergent opinions on Bitcoin or cryptocurrency in general, but I think it has a future. It's just a matter of when.
Will it ever take over the dollar? That's tough.
Well, maybe it'll make them stop printing so many of them.
That wouldn't be a bad idea.
Yeah.
But anyway, y'all have a great evening. Thanks for spending some time with us tonight. We hope it's been beneficial. Anybody that wants to talk offline or give us a call, we can be happy to answer your questions or concerns. But y'all stay safe. We want everybody well. Take care now.
Thanks. Bye-bye.